Hi everyone, my name is Mrs. K.KARPAGAMBIGAI, Department of Business Administration, Dr. S.N.S. Rajalakshmi College of Arts and Science. Now we are going to see about what do you mean by fund flow and cash flow in management accounting. So a cash flow is a statement showing changes in cash position of the firm from one period to another. It explains the inflows and outflows of cash over a period of time. The inflow of cash may occur from sale of goods, sale of asset, receipt from debtors, interest, dividend, rent, issue of new shares and debentures, raising of loans, short-term borrowing, etc. The cash outflows may occur on account of purchase of goods, purchase of asset, payment of loans, loss on operation, payment of tax and dividend, etc. A cash flow statement is different from a cash budget. A cash flow statement shows the cash inflows and outflows which have already taken place during a past time period. On the other hand, a cash budget shows cash inflows and outflows which are expected to take place during the future period of time. In other words, a cash budget is a projected cash flow statement. Next, we are going to see about the fund flow statement. It states the changes in the working capital business in relation to the operations in one time period. The main components of working capital are current asset, that is cash, receivables, inventory. Then current liabilities is nothing but payables. Payables is nothing but we are the liable to pay the amount. Next, what is included in cash flow statement? A cash flow statement comprises information on the following three activities: operating activities, investing activities, financing activities. Operating activities is nothing but it includes cash flows from all standard business operations. Cash receipt from selling goods and services represented the inflows. The revenues from interest and dividends are also included here. Second one, investing activities. Investing activities include transactions with assets, marketable securities and credit instruments. The sale of property, plant and equipment or marketable securities is a cash flow. Purchasing property, plant and equipment or marketable securities are considered as cash outflow. Loans made to borrowers for long-term use in another cash flow. Collections from these loans, however, are cash inflows. Third one is the financing activities. Financing activities under statement of cash flow are much more defined in nature. The receipt comes from borrowing money or issuing stock. The outflow occurs when a company repays loan, purchases treasury stocks or pays dividend to stockholders. As the case with other activities under statement of cash flows depend on activities rather than actual general ledger account. Now we are going to see about the difference between the fund flow statement and cash flow statement. The first one, fund flow statement is based on broader concept, that is working capital. And cash flow statement is based on the narrow concept, that is cash, which is only one of the element of working capital. Then source, fund flow statement tells about various sources from where the funds generated with various uses to which they are put. Cash flow statement starts with the opening balance of cash and reaches to the closing balance of cash by proceeding through sources and uses. Fund flow statement is more useful in assessing the long-range financial strategy. Cash flow statement is useful in understanding the short-term phenomena affecting the liquidity of the business. In fund flow statement, changes in current asset and current liabilities are shown through the schedule of changes in working capital. In cash flow statement, changes in current asset and current liabilities are shown in the cash flow statement itself. End result, fund flow statement shows the causes of changes in net working capital. Cash flow statement shows the causes of changes in cash. Fund flow statement is in alignment with an accrual basis of accounting. In cash flow statement, data obtained on accrual basis are converted into cash basis. There are advantages. It shows the actual cash position available with the company between the two balance sheets dates which fund flow and profit and loss account are unable to show. So it is important to make a cash flow report if one wants to know about the liquidity position of the company. It helps the company in accurately projecting the future liquidity position of the company, enabling it arrange for any shortfall in money by arranging finance in advance, and if there is excess, then it can help the company in earning extra return by deploying funds. There are disadvantages since it shows only cash position. It is not possible to deduct actual profit and loss of the company, but just looking at this statement in isolation is of no use, and it requires other financial statement like balance sheet, profit and loss, etc. And therefore limiting is used. Thank you.